Hello and welcome back to All Things Money. I'm your host, David Blain. If you missed the first segment, we were talking a little bit about the buy and hold strategies. Is it dead? If you missed that, head on over to the web, www.dlblain.com. We'll have archives of the show posted there in a week or so, and you can catch up to what we talked about in the first segment. During this segment, we're going to continue our discussion a little bit about the markets and some of the things. We're going to talk about a very interesting story about an attorney that was disbarred trying to sell annuities to an elderly client. And then we're going to talk about the Supreme Court's ruling on Obamacare and the implication it has for investors. Not necessarily the ruling itself, but because of all the uncertainty around Obamacare, a lot of the provisions, I mean, we knew they were there, but we didn't really analyze them. Well, guess what? Now we really need to dig into it, figure out what's gonna be going on in the future, because there's a ton of new taxes in there, and if you're not prepared, they're going to sneak up, and you're going to be unprepared. Before we get into that, you know, this year, once again, from about April to say the end of May, the stock market declined significantly, causing a lot of anguish to people, maybe a little bit of panic. And you know, this happens every year, more often than you would think, and that's why we try to be a student of the market and look at history, what's happened. And so we ran some data from 1928 to this year, and we broke stock market declines into what we call a dip, which is a 5% or more decline, a moderate correction, which is a 10% or more decline, a severe correction, which is defined as a 15% or more decline, and then a bear market, which we define as a greater than 20% decline or more. Now, if you're sitting there at home reading, I just wanted you to think, you know, well, how many times per year does the market go down more than 5%, 10%? I think these numbers will surprise you. So we'll look at the number of times the market went down 5% or more. The number was 294 times. It doesn't really mean anything. We'll stick with the number of times per year. That's an average of 3.5 times per year the market went down more than 5%. The average decline was 11%, and the average period of time was 36 days that it stayed down that long. So the market going down 5% or more, I guess the point is it's a very regular process. So if you have 3.5 times per year and on average duration of 36, you're looking at, you know, anywhere from 3 to 6 months per year the market being down. If we look at moderate corrections of 10% or more, the average number of times that happens per year is 1.1. So in any year, you should just flat out expect that the market go down at least 10% or more. The average decline in those instances was 19.6%. So it's very, on average, went down at least one time, more than 10%, and that number was almost 20%. The average duration, 102 days. So stays down for quite a long time. A severe correction, as we define, 15% or more. Average times per year, 0.5, which basically means once every 2 years you can expect the market to go down at least 15%. But here's the key. When it does go down at least 15% or more, the average decline has been 28%, and the average duration has been 191 days. So just about a little over half a year. It happens very frequently. And then, of course, bear market, 20% or more decline. Historically, this has happened 0.3 times, or taking the inverse of that, roughly once every 3 years, the market goes down 20% or more. And on average, when that happens, the average decline is actually 35.7%, and it stays down for 299 days on average, so almost a full year. So when we kind of put all this together, in fact, the industry, the investment industry, my own industry, is very bad at explaining the experience that an investor would have. We talk about, well, the average return of stocks is 8, 9, 10%, whatever. But In the typical year, you can see it's very volatile. There's a quite significant amount of the time where the portfolio is actually negative. So, for example, if your portfolio grows to $1 million and then it declines, those are the number of days that it takes to reach back even. So you see once every 3 years, for almost a year, you're below whatever high mark that you may have achieved. So it's very important if you're going to be an investor, and I ran this for the U.S. stock market. The same thing applies overseas, Europe, Japan, emerging markets. It applies if you're investing in commodities. It applies if you're investing in real estate, public real estate. It applies if you're investing in the bond market. Now, some of the numbers may not be so severe, but the point is that investing is not a smooth ride. That's what we try to do when we design portfolios, is by mixing stock investments with bond investments or real estate or commodities or something like that, is to try to smooth that ride out. But it's not always possible. And so if you're going to be an investor, you just have to be prepared for markets to go up and down. During the remaining part of the show, we want to talk about the Supreme Court's ruling last week on Obamacare, or the Patient Protection Act, and some of the taxes that are going to come into play. A wealth of new taxes. We're going to stay away from, whether it was right or wrong, or whether Republicans can repeal it or change parts of it. The reality is we have planning right now that looks like we need to start planning for, and so we want to outline some of those taxes for you. We're coming up on our second break. When we come back, we'll start talking about some of the taxes that you should be prepared for.